Good morning, everybody, and welcome to one of our Saturday morning sessions. We used to call them open microphone, open keyboard. I think what we're going to attempt to do is on those Saturday mornings where I'm not running around somewhere, and it's basically an available Saturday morning. We're going to start doing more of these, a couple a month perhaps. And I have kind of captured that old title that used to be associated with me at Better Investing when I served as a senior contributing editor for Better Investing magazine. A few moments with. We're going to basically spend some time with concepts, some wonderful stories, some people going forward this year, and I think we can have some fairly interesting moments. So a few moments with. Going to spend some time this morning just reinforcing some of the stuff that we did Thursday night during the webcast for the DC regional chapter of Better Investing, and had a great time. But we did mention this thing called the Sandboxes, and we spent a lot of time talking about the stuff that's really important in portfolio design and management. So we're going to spend some time with some of the tools and resources demonstrating some of the, we think, fairly powerful resources that manifest. And again, we'll encourage all of you to participate. Again, if you're fairly new here, welcome, a big welcome hug. I see many familiar names. Again, if you have a comment or a question along the way, this is wide open. Just simply raise your hand and we will unmute you if you have a microphone. Otherwise, I will be doing my best to monitor the questions tab. And so if you guys have comments or questions along the way, please feel free to do that. The last image there on the right is just simply a reminder that we have one of our special roundtable sessions coming up on March 1st. It's our red carpet, black tie affair, and would encourage you to take a look at that. Down at the bottom of the page, if you'd like a copy of either the slides or you have any follow-up questions or commentary, my email address is there at the bottom, and my Twitter handle or address or whatever they call it over there at Twitter is at ManifestInvest. And in fact, I would recommend any of you that are just in the mood for tinkering a little bit, I'll probably put on a webcast on Twitter here very soon. We've started to get some requests about how does this possibly make sense? What in the world is this thing? And I think we can come at it from the standpoint of how to use Twitter in the world of investing and, basically being prudent stewards, following our stocks and people whose opinions we respect, and basically just keeping tabs on the rhinos themselves. So we may take a look at Twitter here in the future. Let's get some housekeeping out of the way first. All of you guys know this. No investment recommendation is intended. We are willing to pull up real companies and talk about them. Everything that we do here, everything that we always do here is an educational demonstration. It's about a method. It's about a philosophy that many of us have followed for decades. And we think it's extraordinarily successful. No other way to put it. And we really enjoy sharing it with people and enjoy it when all of you out there share it with friends and family also. So again, no investment recommendation is intended. You guys do know that. Here's kind of a outline of some of the stuff I would like to cover. Again, it's wide open, but I do want to spend a little bit of time talking about the weekly nudges. We covered it on Thursday night. Many of you wrote to me and said, boy, I didn't even know that was going on. It falls under the category of if you own a stock or if you're a member of an investment club where you have stock watcher responsibilities, we think that some of this stuff could be pretty cool. So we'll show you what we're talking about there. And many of us certainly fit either one or both of those categories. Okay, and then we'll spend some time with the sandboxes. We're going to take a look at two flavors of sandboxes at Manifest Investing, one for looking at individual stocks, the other looking at portfolios. Now I want you guys to do a favor for me, something that I've been kicking around for quite some time, this notion of getting in touch with Jim Cramer. I'll probably do it through Twitter, by the way. Getting in touch with Jim Cramer and suggesting some of the stuff that we do in our community might become part of his Am I Diversified component. And we'll leave it open at the end for, seriously, whatever's on your mind. If you want to do our own version of not a lightning round, but a thunder round, we can certainly do that. Take a look at some of the stuff that you guys want to talk about and just let me know. Here's your first reminder. Again, March 1st, 2014. It's going to be on a Saturday morning, so it obviously would preempt any presentation of a few moments with. Instead, we'll invite you to spend a few moments with a bunch of us. All the knights and the damsels, and guest nights and guest damsels at the round table. We'll have as many of them as are available. And we basically take a look back at not just 2013, because we want to look at what worked, see what lessons we might learn, but also look back at what is now almost 4 years of roundtable stock selections and how they've done. So again, you can go to manifestinvesting.com, the events tab, and get registered for that. Tell your friends to come on out for that one. Okay, let's put a little context on all the stuff that we do. We are going to be spending some time in the Sandbox talking about companies and analysis. This is a slide that we used on Thursday night with the DC regional crowd. And it's just a reminder that this is what we do. We basically take companies and we build pictures, we build visions of, how has the company done, where has it been, where is it, what paths has it been on, and what roads might lie ahead. And it's really pretty simple stuff. We build a top line and a bottom line forecast based on our understanding of the business model for the companies. We like steady, consistent business models because they're easier to predict. And when we find a company that is relatively stable and consistent, and then we find that it's at a price that is relatively attractive compared to history, we'll usually jump all over it. A couple other just quick reminders on here. Again, every time you see this picture at Manifest Investing, the real thing we're looking for here is the long-term trend with respect to either sales. We're going to talk a lot about the financial companies here in a few minutes, where we actually look at book value growth instead for some of those, but growth of the company over time, long-term trend, long-term characteristic, and again, as he's regarded as the grandfather of the modern investment club movement, George Nicholson Jr. Mr. Nicholson basically said, pay a lot of attention to the trends, focus in on the trends, and then by very definition, focus on the things that become threats or opportunities to that trend. So anything that might kick that thing in the gut or offer considerable promise in the future. Again, threats and opportunities. We talked about that a lot on Thursday night also. The other reminder that's here, we're always looking at 5-year time horizons. That's the big green arrow here. 5-year time horizons. So anytime you see us present this type of a graphic, the right-hand side of this chart is always going to be 5 years. And we always are forecasting off of the trends. Okay, let me go ahead and fire up the Maddenator. Not showing any hands in the air and no questions, so let's just keep pressing on. Some of you have seen me use this slide before. Again, I just wanted to grab it as a concept or an overview slide just to remind how powerful this stuff is, because what we do, based on the teachings of Nicholson and Babson and all the gurus of better investing in the long-term investing community over the years, is this concept of being patient and disciplined. And then an even more powerful word, it's my favorite word to describe what we do, imagine. Imagine what that business model will look like, and imagine what investors will be perhaps able to pay for that company 5 years in the future. That's where we get our return forecasts. And it's literally no different than what Mr. Buffett does when he sits and puts his feet up on his desk and takes a sip of cherry Coke, and whatever company he's thinking about buying, maybe another railroad just for kicks, that's what he's doing. He's basically patient. He's looking at a very long-term horizon, probably 5 to 10 years based on the things that he's said, and he tries to imagine what that company will look like and what their market will look like and what the field of opportunity will look like 5 years out. And that's what we try to characterize when we build our forecasts for companies. So again, that all comes into play. And anytime we're talking business model analysis, we're trying to be vigilant and build a vision and understand that vision and share it with our club partners or fellow investors. All right, let's switch gears a little bit and talk a little bit about something I described to you guys and we've been talking about in some of our correspondence and publications here lately. Let me do a little housekeeping over here on another monitor. Okay, this is from the Manifest Investing Forum, And every Monday morning we put out a quick summary of what looked to be potential stocks to study from an opportunity standpoint. At the same time, we go through and we talk about companies that seem to be potentially materially stronger with an uptick in the long-term forecast, or materially weaker, a deterioration in the long-term forecast. In the issue that came out last Monday, Amazon.com, ticker symbol AMZN, actually took quite a hit in the long-term forecast according to Value Line. Now, we all know that could be just one opinion. So one of the things, as you guys all know, we pay attention to the opinions at places like Morningstar and Value Line. This happens to be the companies that will be coming out this week in Value Line. So you can see all these are Value Line issue 1. And what we've done is gone and taken Friday's closing price and compared it to the Morningstar fair value. They basically do a very similar process to what we do at Manifest Investing and within the investment club community, only just kind of backwards. They're calculating basically a fair value instead of a return forecast. And a company that is on sale is a company that is at a price to fair value, this P over FV, price to fair value less than 100% or 1. You might see Morningstar actually presents it as a 1.00. We call it 100% here. Companies that could be attractive, according to Morningstar, starts with Ford. Now, that is a 4-letter word in our house, but with my spouse working at Chrysler. But again, Ford could be an interesting long-term opportunity. We might take a look at that a little bit later. Certainly not a typical core holding for one of our in our community, but it can be an investment opportunity from time to time. And just going down the list, you can see that they actually fairly rapidly approach 100%. We did include some of the weaker companies. These are, weaker quality ratings. The reason for that is either they have weaker balance sheets or they're bumpier. They have more cyclicality in their business. Certainly true for the ones at the top. Those of you that are joining us from the Michigan area here today certainly know that the business cycles are a real bear around here. We happen to be in the middle of a very fairly robust business cycle, especially when it comes to automobiles. So any of you out there that have bought an automobile in the last year or so, we thank you. So just go down the list. Again, this is just kind of, if you've had one of these companies perhaps on your watch list or thought about it, this is just Morningstar throwing up a flag saying, hey, you might want to dig in and take a closer look. Baxter kind of jumps off the page at me. Toyota, perhaps, although I'm not allowed to invest in that as I live here, or my neighbors would set our cars on fire in the driveway, so we have a little bit of an inhibiting factor there. The other thing I wanted to mention is this notion of too good to be true. Again, 100% is fair valued. So the farther or the more deeply discounted it gets, the more cautionary you ought to be. In fact, some of the best stock pickers in the Morningstar Ultimate Stock Pickers feature that they do, they tend to shop down around here, very much like we do with our sweet spot. And they'd be a little bit more reluctant at the top of this chart. Again, potentially too good to be true up at the top of the chart. But again, my message to you is this is already out for yesterday. This is part of what we put out every Monday morning in addition to the Value Line stuff. Let's take a look at the Standard & Poor's version of this. Again, same companies, all from Value Line, issue 1. They'll be getting their Value Line updates on Monday morning, and we'll be cranking across the updates in all the fundamental categories on all these companies, but a little bit different list. But again, kind of an intriguing Toyota moment here. I know there are a few people in the community that really were investing in Toyota back when they had the nightmares with the braking problems and all of that. And again, if you can come to grips with that stuff and really build a long-term perspective, something we'll be talking about here in a minute on Bank of America, sometimes those can be very outsized opportunities. And again, you don't have to marry these guys. You can take advantage of opportunities and exit them when the time is right. So again, looking down the list, there's going to be some commonality between the lists, but one of the things about markets and the world of investing is Morningstar and Standard & Poor's don't always agree. And in fact, sometimes we focus in on where they disagree the most. But again, a fairly decent shopping list, some deep value opportunities, but some fairly nice, relatively some of these are probably in the sweet spot down here in the middle of this range. Any questions or comments at this point on either one of those? I'll jump out and show you where to find this just so everybody knows. If you go to Manifest Investing and go into the forum, I'll come through the front door here. If you come into the forum at Manifest Investing, go to General Discussion, and I'm going to go to last week. I'll show last week's first, and then I'll show this morning, what will be coming out with Monday morning. We usually have some commentary. The commentary here has to do with, it's really been kind of fascinating to watch the fundamentals erode away on many of these stocks. You know, all these stock prices are taking off and seem to be headed for the sky. The fundamentals have actually been eroding in terms of profitability. We're almost at recessionary conditions towards the end of 2013. Now, it's really kind of an interesting thing because I think the recovery is real. It's just really sluggish, and they're just plodding along, and probably not real healthy in terms of responding to a major upset. So just something to think about. Here's the value line list from last Monday morning. And again, we just post the companies that are in the potentially too good to be true zone, along with some sweet spot companies. Again, notice that they're all issue 13. And again, I would probably be inclined to study, if I was considering some of these for purchase, some of the higher return candidates, perhaps in the middle of the chart here, that have the higher quality ratings. And then, as I was mentioning with Amazon a few minutes ago, every week, every Monday morning, we put out the companies and the ones that had substantial increases in the long-term return forecast. LinkedIn happened to fit that category last week. And as I said, Amazon.com fell into the materially weaker, and they actually had downdrafts in a bunch of different fundamental categories last week. So you might take a closer look. And again, if you're a stock watcher for an investment club, or if you have Amazon in a portfolio, could be a buying opportunity. Could also be an opportunity that's signaling extended long-term weakness, and you might be watching for a selling opportunity in a personal portfolio. That sort of thinking. Again, nothing to panic over other than to just simply be aware, be prepared to share changing conditions with investment club partners. Here's the Morningstar price to fair value nudges from last week. Again, just to show you how they're presented at Manifest, and there's the price to fair value nudges from Standard & Poor's. So again, that's something that we do along with a few barometers at the bottom. But again, you find them in the forum under general discussion. And just to show you where the charts I just presented are, again, the value line stuff can't be done until Monday morning, so it's got a placeholder for it, along with a placeholder for some commentary. But here's your Morningstar and Standard & Poor's price to fair value nudges. Try to give you a dozen or 16 or so. And I think in the future, especially if we stay at fairly elevated stock prices, and the opposite of elevated, whatever that would be, in the trough return forecasts, we'll probably also be paying some attention to the companies at the bottom, much like we did a few weeks ago with 3M, when we were suggesting that 3M, even as a core holding, was kind of falling into a sell zone consideration. Okay, so that's one of the vigilance things we wanted to keep you aware of. Anybody guys have any comments or questions or wish list stuff at this point? I'll take a sip of my second cup of coffee this morning. Yeah, looks like you're all fine. Again, I don't see any hands in the air. Again, keep in mind, especially if you're new here, if you do have a microphone equipment on your computer, if you raise your hand, we will mute you or unmute you. I'm going to go ahead and unmute Irina Clements. Hi, Irina. Good morning.
Hey, Mark. Thanks so much, by the way. This is incredibly value added for the subscription here. You've done a whole lot of upgrades.
Thanks.
In your articles, is there a capability where you've embedded an Excel spreadsheet so that we can just click and download and then manipulate on our own?
Yeah, I'm not quite as familiar with that as people like Kurt are, and I notice other people doing it, but most of the stuff I know is downloadable. If we jump out and take a look at, for example, are you talking about, give me an example of something you would want to take a closer look at.
Oh, like if you could just spool down a little bit on the page you're on right now.
Okay.
Okay, so we're looking at these 12. I find it fascinating that you've got the Manifest 40, the Value Line, Morningstar, S&P, all kludged together. And I'm a visual person, so if I could somehow click on the top 12 and the bottom 12, and then I pull together what S&P says, what Morningstar says, the MI 40, blah, 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 and it just, I'd rather not, instead of me fat fingering and saying, okay, let's see, 94 is Baxter, it's just another way for me to put it together and sort it.
Okay,
you know what I'm saying? Maybe
yeah, I do know what you're saying. You're describing Solomon, our database.
Sorry.
Yeah, it is possible to do that. I mean, if you send me a note, just as a reminder, we could perhaps. I mean, well, let's take a look at Solomon. I think what you're describing is.
Oh, this is sweet.
Yeah, this is.
Everything behind the scenes, I'm thinking, right?
Well, it is behind the scenes, but obviously, it's behind the scenes we have it. Now we can't publish these numbers. You got to get them yourself.
Of course not. No,
But you know, so if you put it in terms of that we can publish, we can't publish those either.
Of course not. Yeah.
But now you've got and not this one either. But now you've got a list of stocks. Let me show you. There's actually a ticker here. Here you've got the value line, low total return forecast, Morningstar, S&P. You're saying you want that all side by side?
Yes, that would be extremely cool.
Downloadable format.
Yeah, sometimes AAII, within their articles, they have a spreadsheet downloadable, and you can just, even I could put it together myself if I just get the, if you just have within your article that small Excel spreadsheet. So I'm not advocating an incredible amount of work, just that capability.
Okay, and let me talk to Kurt about maybe putting together some type of an export that would give what we were just looking at.
I'm going to mute myself because I just had people come in.
That's all right. Okay, thanks, Irina. All right, anybody else have any comments or questions? Okay, let's go ahead and press on. Come back to something we talked about a little bit on Thursday night, something that we have talked about in the past. It's a very key area in our next wave of development. And I'm actually kind of excited because after a couple years of dealing with some other stuff, and we'll just leave it at that, we're gonna move into a very interesting area of exploration, and it involves some. First of all, we have to update the platform that Manifest Investing resides on. So just simply rolling from one version to the next, but that obviously involves some programming. Very little will change with respect to that. That's all going to be behind the scenes. But as we do that, Kurt and I and all the people affiliated with Manifest Investing, you know, your Hughes and Kens and everybody else, want to take the opportunity to seek out well, stuff like Irina was just talking about, stuff that could prove useful. And these are two key areas where we're going to be watching for stuff that makes sense, but again, always with this notion of keeping it as simple as possible also. But at the same time, why not harness the power where we can? And some of it has to do with these things that we've called sandboxes, these play areas where you can literally do sensitivity analysis or play these what-if games. We're going to talk about these audits, the audit capability for stock studies that we've put together over the years, and that's something that we'll be getting a lot of TLC and design. We're already working on it now, so hopefully we'll be able to get something out to you guys fairly quickly. And then the dashboards and these what-if worksheets that we've talked about. I want to start with a real example, and it leads us into an interesting area where I can clarify for you guys some of the stuff that we've done and take some of the mystery out of some of this stuff. Any Breaking Bad fans out there? going to talk about Bank of America here in a few minutes. And the reason I'm going to talk about this is because it's a great example of those of you that have been around the community for a few years can probably remember. In fact, you can find posts on the Manifest Forum where people like Hugh McManus and Julie Werner were talking about buying a bank back about 5 or 6 years ago. And in order to do that, you really had to grit your teeth and envision a successful future. And I think, I don't see Hugh's name on the list here, so he wasn't able to join us this morning. But again, his whole concept was that Bank of America wasn't going to disappear from the planet. And even if it did, it was probably going to be scooped up by somebody else or whatever. The entity that was Bank of America was probably not going to be allowed to fail because, again, he describes it much better than I do, but talks about how the economy and banks are one, and they really are connected at the hip, and you can't allow too many banks to fail or our economy would literally fall apart. That's why this too big to fail concept or whatever exists. So I want to take a closer look at Bank of America, and it'll allow us to demonstrate the process of, what if you have a concept or a feeling or a deeper understanding where you have different information than perhaps even a fairly vast number of analysts, like a bunch of analysts follow Bank of America. How can you bring your analysis and possibly seek an outsized opportunity? For those of you who follow the roundtable, you know that Hugh selected Bank of America, I would say roughly 3 years ago, and he selected it multiple times. And it proceeded to go up a couple of 100% here over the last couple of years, leading to his championship in the roundtable a year ago. And it continues to be an interesting story. And I also want to wrap this around, a confession. Our stock study tool gets messed up by one category of companies, and that's what the purpose of this slide is. Again, if you're not a Breaking Bad fan, you just have to smile at these guys sitting here looking. I believe that turned out to be $80 million in cash that they had come up with over the years, and it'd be kind of fun to lay on that and roll around a little bit. But who out there can tell me, when it comes to the investing arena, what does the acronym or the abbreviation AUM stand for? Either by microphone or by clicking in comment under the question tab. Because this is the major distinction that we want to make as we describe this in the next few minutes. So what does AUM stand for? Okay, Irina's got her hand up, and Linda Hunn actually beat her to the question under the question tab. It stands for assets under management. And there's two kinds of companies. When you look at the value line 1700, there literally are just two types of companies. There's the industrial companies, the McDonald's, the Boeings, the Microsofts. Those are basically industrial business models that we study using the business model technique that we talk about. And then there's this other class of companies, and these are all assets under management companies where the business model is different. It literally is build a pile of cash and then make money off of that cash. So that business model applies to a fairly select group of companies, and that select group of companies happen to be banks, insurance companies, some of the brokerage firms, some of the money management or asset management firms. But again, their whole mission in life is to generate a pile of money and then make a return on that pile of money. So it's a different business model than Oracle or any of the other industrials. Now, 99.9% of those companies are going to land in the financial sector. So anytime we're dealing with a financial sector stock at Manifest, at some point we have to switch over and use a slightly different business model analysis. The business model analysis that we use is we keep track of book value and return on equity. And it's only for these assets under management company. Now, you could have a company like Visa or MasterCard. It's not the same thing, although they want to collect up as many, they want a pile of plastic card users as big as possible. But their business really is a service business related to the number of transactions. They make a certain amount of money off of each transaction. It isn't a matter of building a pile of money. So that's a financial sector company that has an industrial business model. So we would treat that differently. So hopefully that will take away some of the mystery. I want to talk about this opportunity that Hugh and Julie described back in the latter half of the last decade. And here it is right here for Bank of America. You literally had Bank of America along with virtually any other money center bank, almost any bank. Almost no banks were immune to this. They fell apart. The wheels absolutely came off. It didn't stop at the lug nuts. The wheels came off. And how is that manifested in the business results for the company? You can see it right here. The profitability is measured by return on shareholder equity. Went from basically the 20s and high teens for most companies in this classification, dwindled down to nothing, basically zero, and stayed there for quite a while. These things were badly damaged. You can see the negative earnings up here in 2009, 2010. You can see a decline in book value. That's not a growing book value. That is a book value that's getting beaten senseless over time. So basically back in this time frame, you can look at the forum posts. I have all kinds of correspondence from Hugh. He's like, you know, I don't think these things are going away. I think they're going to come back. I don't know that they'll ever come back. By the way, here's your value line financials. These are just the financials. Profitability as measured by return on equity. So it's all the banks, all the insurance companies. They used to be up here. The Great Recession happened. They got literally sucker punched, and all of them ended up down here. Some were better than others. Some of them disappeared from the planet. Nasty stuff went on, but then we would sit around scratching our heads about what might the future hold. And many of you out there know that dragons have been put on medieval and maps going back for centuries at the edge of the maps where they didn't know what was beyond what had been explored. So the Darby dragons out there, that was basically a danger sign, you know, back in the Flat Earth Society days when they thought that the edge of the world was flat, you might fall off the edge. They would put dragons on maps because they didn't know. And that's kind of the situation we had here with not just Bank of America, but all of them. And the Darby Dragons was a big deal. So we're going to come back and take a look at kind of the concept of what McManus was looking at, and how it makes sense in terms of that kind of stuff. But let's go back to the other type of company, those industrials. Again, this is probably 95% of the 1,700 companies. I don't know the exact number, but it's something like that. 95% of the companies that we cover work just fine under the MyStudies tab at Manifest Investing. We want to talk a little bit about Cognizant. And again, anytime we do a business model analysis of a company, we're really honing in on this long-term top-line characteristic and trend. And again, for a company like Cognizant, at the point it is in its life cycle, it is going to do some plateauing. It's got to slow down by definition, law of big numbers. And so we're going to pay attention to the right-hand side of this, as we covered on Thursday night. And those of you that have been around Manifest Investing for a while know that we embed a couple years of analyst estimates in all of our work at Manifest Investing. So these are always going to be embedded. And the reason we do that is we're watching for any influence up or down that these might have on the long-term trend. Again, up would be opportunity, down would be a threat. So we're always watching for that. But we want to come away with an understanding of what this long-term characteristic looks like and what a general growth rate is. So this picture is all about growth rate. For Cognizant, the fairly recent value line had the low total return forecast at 12%. So we're going to be watching what we do for that 12% number. Pay no attention to the 18. The 12 is what you want to always benchmark against and audit and gauge your results. Okay, Mike Higgins asked, well, how can you have a positive ROE when you have a negative EPS? I don't know. Did they do that? Boy, I don't know the answer to that one. That would be a good question for the value line analyst, Mike. Might come back and take a look at that. He's talking about here they had negative earnings, and these are actual reported numbers. I suppose there could be some adjustments. I don't know the answer to that question. We'll have to dig in and see if we can't figure that out. That is weird. Chances are it's a mistake on value line, and they don't make very many, but they do make some. Okay, so back to Cognizant. We'll come back to Bank of America here in a minute. But so 18%, put 18% in your memory bank. profitability analysis. Again, you can get as fancy as you want. It all comes down to the trend, the longer-term trend with respect to profitability. In the case of an industrial company, we keep tracking that margin. Basically the bottom line. And yes, we're fully aware of all the accounting gimmicks that can be done and all the mechanics and gymnastics that can be done, but you know, put on a common platform, it's okay to look at it this way. We can talk later at other sessions about alternatives to that if you want to. Value line uses price to cash flow. You can use cash flow if you want. But in this case, I look at this and do nothing any more scientific than, you know, here's the forecast period, so the forecast is to basically stay somewhere in the 14% range. So 18% growth, 14% margin, I'm cool with that. Maybe a little bit lower, who knows? I mean, you could make a compelling argument to the members of your investment club partners that this long-term trend is headed that way and maybe it needs to be 12. Fine, you could do that. The other thing that you really need is a PE ratio in the future. And, you know, again, what has that trend been? For Cognizant Technology, you can see the numbers from Value Line up here at the top that started up in the 30s and 40s, came down during the Great Recession, and basically they're not going to recover back to those levels, I don't believe. And they're basically maturing. Again, think life cycle. They're maturing, and they're basically settling in on a landing pattern. I look at that, and I see 20. You don't have to get any more exotic than that. Value Line agrees. 20. So 18% growth, 14% margin, and a PE of 20. So with that, let's go ahead and jump out. We'll come back to this in a second and actually demonstrate the tool at Manifest. When you go to Manifest Investing and you click on the My Studies tab, that's your opportunity to do a quick audit. I'm going to get rid of my work for Cognizant here, and let's do a fresh one. Hopefully it'll let me do that. I have not tested this, but I think it'll allow me to go right back and create a new one. This top line is the stuff that's in our database. Again, that's based on the analyst consensus for the company, what's going on, and directly underneath it, now you have your own adjustments and a slightly lower return forecast based on these slightly lower adjustments. And again, you could go in and say, look, our investment club looked at it, and we now really believe that that number should be 12.5, and we really believe that the PE is going to 18. Okay, so now you can see this number has actually been significantly impacted under that set of assumptions. Again, an even lower profit margin, lower profitability, lower PE. You can see that this is now a much less attractive return forecast. Now, if you have a lot of confidence in the numbers you've chosen here, then you do have a different situation. Now, in our next iteration, we're going to probably come up with, and again, we'll be open up for discussion on this, but I think what you'll see us do is give some type of a toggle capability that on your own dashboards, you can actually import this row onto your own dashboards, and there'll be some kind of a flag indicating it, that you're no longer looking at the analyst estimates on a particular company, but using your own inputs on the dashboard. Probably some mechanism to toggle back and forth. Any questions or comments on that? Looking down the field, I don't see any. Just a couple of comments on the value line data for. Okay, we'll keep going here. And again, I think what you'll see us go to, and this is again just thinking out of the box or in the box, however you want to think about it, is again, here's a look at that side-by-side comparison of the analyst consensus results versus ours, the ones that I just cranked through. In fact, I put a 17 in just to tickle it a bit. And here's the numbers that were actually modified, the 18, the 14, and the 17 on display here. But again, in true storyboard fashion, wouldn't it be kind of cool to have that picture, that picture, that picture, maybe even that picture on the page while you're doing the study? Just offer that for your own thinking. A couple of people have to depart. That's fine. Some interesting stuff, huh? So let's go back to this and what actually happened with Bank of America. And basically Hugh's entire thesis over this entire time frame has been that this company is not going to disappear from the planet, probably not going to disappear from the planet, and that this was not going to persist forever. And again, they've been put into a position where they can regain their footing, come back to health. He actually believes that, back when the analysts were forecasting long-term numbers like 4, 5, 6% for their return on equity, he thinks they're going to come back to, somewhere in this range. And if they do, it can represent a tremendous outsized opportunity for a company like Bank of America. Let's take a look at the Eagle, or the worksheet, or MyStudy at Manifest. And I just want you to see that, again, these fall into that 5% of companies that it doesn't work because we haven't done the programming yet. And in the case, well, actually it does work somewhat, but there are some sensitivities here that we need to take a look at. Looking at Bank of America, again, we'd be looking at book value and return on equity instead of sales and net margin. This one actually does work out okay. There's a few other companies that fall into the quagmire. So we've done enough here. We just want to refine this so that we can actually turn this into a tool that even in the case of using price to cash flow in a company like Ford, we can do that. So basically what McManus has been saying for quite some time, and keep in mind this has more than doubled here in the last couple of years, is he's looking up here thinking the analysts are probably wrong about this, and they're probably going to get back to maybe not where they used to be, but levels approaching sort of where they were a few years ago, and he sees an outsized opportunity, and based on that thesis. Again, comparing the two side by side, if the analysts are only willing to accept return on equity staying in the dumps, they don't see any opportunity here at all. And all Hugh is saying is 10% is possible. And if 10% works, pretty dramatic opportunity. So when you run into a company that has all of this kind of messed up, some of the credit services companies that's true for, because we use revenues for those, the transaction companies. If it's a financial company that uses transactions, this could be messed up. But this is an area that we're going to work on improving in the next design iteration. Okay, so again, that's the moral of the story. You can compare side by side. Let's go ahead, and I don't want to go to the diversified stuff yet. Let's go ahead and take a look at the Sandbox thing with respect to dashboards. I'm going to jump to my dashboards. This might take a second. I have way too many. Again, there's a whole lot of number crunching going on behind the scenes, and Kurt basically does fresh numbers for us every time we pull this up for the first time in any given day. So it'll be slower the first time. And yours shouldn't be anywhere near this slow. It's just a matter of I have a lot of dashboards. Okay, so what I have pulled up here is what we refer to as our heavy hogs. Those of you that are familiar with the groundhog, I see a number of groundhogs in the audience. This is the publicly displayed dashboard that has the companies that were consensus favorites from the groundhog for this year. So this should be a pretty good looking portfolio. It always is when you guys are involved. Very decent return expectations, not a whole lot of swinging for the fences, very high quality, pretty good stuff across the board. And what we'd like to do is just use this as a demonstration. I'm not going to mess this dashboard up, and if it was a club or personal portfolio, the same would be true. What I'm going to do is use this Sandbox function referred to as a portfolio or a dashboard worksheet. Copy it to a worksheet, and that basically does a replication or a clone of that dashboard for what-if exercises. So there's actually too many companies here, so I'm going to get rid of a few companies. So let's go ahead and just delete a couple of these. Let's get rid of this one because it's ugly. Set it aside. In fact, let's go ahead and just get rid of it. Ask me if I want to really make it go away. Again, we're just playing. Let's make portfolio recovery go away. Okay. And one of the things you can notice, when I make it go away, it switches it to cash. It pretends that you're selling it. So it actually put the money in cash. So if we want to fix that, we have to go in and zero that back out, or let's leave $88 in it. just to leave a tiny bit in cash. So now we have a portfolio that fits on the screen. So hopefully everybody's with me. So now you basically, if you were going to do a what if, let's say you were in an investment club and you had a couple $1,000s coming into the portfolio, and this is the portfolio in a given month, you can literally play a what if game. Again, you're not messing up the one that's stored permanently in your dashboards. But what you could do is, let's go ahead and sort this by return forecast, projected annual return. And again, these are evenly split up. I mean, this is because we're early in the groundhog contest, they're all right around 5 or 6%. But if this were a dashboard, a real club dashboard, we might look down this list and say, you know what, maybe a little more Apple makes sense. So we could basically put a few more shares into Apple. And if it was a couple $1,000s, it would only buy about 5 shares. Let's go ahead and demonstrate putting the money into cash. Let's put in a couple $1,000s. I'll put in 3,000. So now that money goes into cash. It should ding the return of the total portfolio. But let's go ahead and throw a little bit at Apple. Let's put 4 shares in there. You can see it's taken that money from cash, put it in Apple, and now you could literally gauge the effect on the overall portfolio. Now again, these are all evenly put out, basically 5 or 6% positions across the board. Anything you do to any one of these is not going to have a dramatic effect down here. So we can perhaps demonstrate with a few other stocks in a different portfolio if you want. Anybody have any questions about that? You can also do set-asides. What if we were thinking about the possibility of healthcare services, setting it aside for a potential sale? It's down here. It can be brought back if we want, and then look at what-if situations, maybe adding a company like Coach to the portfolio. So we can put Coach in the portfolio. And much like Ken Cavula likes to do, now it's here in pounce pile type format. There's no shares, so it doesn't have any effect on the portfolio overall characteristics, the averages. But it's now here for comparison purposes. Obviously very high quality. It's a company that's obviously under some pressure. Good study these days. Could be some opportunity and definitely worthy of potential pouncing in the future. Study it and come to your own conclusions. But we could literally take and think about the possibility of investing some shares in Coach. Now we've taken and bought 1,000 shares of Coach. You can see the money came out of cash. You can look at the kind of the before and after what-if situation. We still have healthcare services sitting down here. So if you decided, nah, I don't like that, get rid of Coach, bring healthcare services back, and you're back to where you started. So again, you can kind of use that as a limbo feature down there at the bottom. I would just encourage you to take your personal or club portfolios, go into the into the worksheet component, the Sandbox for a portfolio, and just do some tinkering. Any questions from the audience? I'm going to go ahead and unmute you, Irina. Go ahead, Irina.
Sorry, I was muted. Can you go very slowly and show us again, and I apologize for that, to get from
you don't have to apologize
into this, what-if dashboard?
Sure. In fact, let's go find one that we can mess around with. I'm going to go back to my dashboard home. This will take a second. Now I'm abandoning what we just did. That's not saved anywhere. It's all gone now. You can save it. You can save it as a proposal dashboard, or you can replace the original. You can do either of those things. I don't want to do that because I don't want to mess up the heavy hogs. But let's go ahead and come down here to, let's find, you can see I have way too many dashboards. Don't yell at me. We want one with a little bit of, let's take a look at, here's a model club. Okay, so we're into a club that this one's a little bit better example because we do have a Google is 12% of total assets, and they have a little bit of cash down here. And again, I'm going into my vanilla dashboard, the real dashboard, and I'm going to say, okay, I want to do some what if. I want to jump into the Sandbox. You copy it to a worksheet. We only keep one worksheet active. We don't have a component for saving these yet. You can save what you're done with, but you can't save works in progress for more than one. And that's for protective purposes. Don't want people, don't want too many calls from people saying you need to restore all my dashboards. So all I did was I copied it to its own worksheet, jumped into its own Sandbox. Is that okay, Irina?
Absolutely.
Okay.
Sorry,
So
I somehow missed that.
That's okay. So now we jumped into it. So we copied it to its own worksheet. Now in this situation, we've got something that's a little more real. We've got a huge position up here at the top. If we sort this one by the return forecast, again, if we were looking to improve this portfolio, and I think it probably could use it, why do I say that? It could stand a little bit more growth, but more importantly, it's got plenty of quality. It's rarely an issue for one of the clubs in our community, but it doesn't have enough return. And part of that is because it's got quite a bit of cash here. But some of these are dragging it down at the bottom. So the first order of business would be invest the cash. And let's go ahead and jump out to a quick stock search. Let's see what we might find. Let's go hunting for stocks that are in the sweet spot of high quality, high financial strength, and let's go grabbing for some growth. I'm putting in 14 instead of 12. I want a little more growth. And we come back with some fairly interesting possibilities, top to bottom. We didn't look at sectors at all to guide us, but if I'm looking at these again, C-Trip and Baidu could be interesting. But again, when it comes to Chinese companies, if you deal with the really large ones, you're probably less at risk. I mean, there's no risk-free investment anywhere on the planet, but Baidu is not the same as buying a small Chinese company. So let's take a look at the impact of putting Baidu in the portfolio. Obviously, you'd want to study it completely, but let's go ahead and add Baidu to the portfolio. We'll do it first as a watch list, potential watch list. And again, what you see here, I'm sorting it by par now. Baidu does not have any shares, so again, it's not affecting the overall portfolio yet, but you can see it stacks up pretty nicely with some of these other companies. So for that $7,500 that's out there, we could buy a few shares of Baidu. Clicking on the little pencil there, let's buy 50 just for kicks to see what that does. Well, 50 used all our money, so I actually overdrew the account, but forgive me. And you can see that now Baidu is in the portfolio. It's 9% of total assets. Probably couldn't buy 50. We might have to buy less. But again, what we now have is a slight uptick here in the return forecast for the portfolio. Growth is a little bit higher also. So again, we might look down the portfolio. Perish the thought, but Walgreen has been on quite a tear. And I mean, those of you that bought into it when I did, I'm patting myself on the back here, a couple years ago when it was in the 20s. It's been very, very good to us. It does appear to be strengthening fundamentally, so I wouldn't rush out to do this. It's a core holding, but for purposes of demonstration in this portfolio, you might do a set aside. Putting Walgreen down here, saying, well, what if I put Walgreen, what if it's a candidate for sale? And again, going back to that list we just had, what might we replace it with? Okay, well, let's pick a Washington, D.C. company since that's where you're from, Maximus. You do any business with them, Irina?
No, I don't.
Okay, Maximus. So let's go ahead and put them in. Pretty good company. It's a consulting company. I'm not sure exactly what they do, but they do a bunch of companies. They do a lot of government work. And at 46, let's go ahead and put in 100 shares. And again, our Walgreen is sitting on the side. And again, we've given a slight boost to the overall portfolio in terms of growth. We did not mess up the quality, financial strength, and the straightness of the lines on the stock selection guide are still going to be pretty good. Earnings per share predictability, okay. And we've given a slight boost to the overall return of the portfolio. So over time, you can gently coax this thing into a target range. The target range we recommend is 5 percentage points above the market. Today's market is right at 6%. That is the average or the median return forecast for about 2,300 companies at Manifest. So we would try to get this portfolio up to 11. Don't have to do it overnight, but if this were my money, if this club actually handed it to and gave it to me, I would be watching for opportunities to do some of the stuff I just demonstrated. And again, even though Walgreens is practically an adopted member of our family, I'd sell it if it runs much higher. And look for a high-quality replacement candidate, and however long it takes to do that. So does that help, Irina?
Excellent. Thank you so much.
Go into any one of your dashboards. The door to the Sandbox is through the Copy to Worksheet tab. Okay, so those are 2 Sandboxes. Go away and play with them and bring back your questions or any comments or issues that you have. And again, whoops, Bank of America, probably not going to stay down there forever. Neither are the banks. Many of us in the community, myself included, probably missed some magical investing opportunities back in this time frame with the banks. The kind of opportunity that we talk about lovingly and almost enviously with a company like Wells Fargo that got down to like $1 a share back in the early 1990s after the savings and loan crisis or whatever banking fiasco happened back in the early 1990s. Anytime that happens, again, I think it's prudent to search for the companies that you think will survive and then really make a gut check as to where you think they might go. And again, don't do this with a huge part of your portfolio, but if you are an experienced investor, sometimes you can really spot an interesting opportunity. So we'll leave it at that. All right, looks like the questions are clear. I want to play a little bit with Am I Diversified? And we're running up at about an hour. We'll go for a few more minutes, leave the floor open for questions, and then release everybody to their Saturday. There's probably anybody here that's not familiar with Am I Diversified on CNBC's Kramer, the show that's on every weeknight. And I just want to propose an interesting thought. Basically, for those of you that are not familiar with it, a caller will call in and name 5 ticker symbols pretty quick, and what they do is they literally pull up the logo for the company and display it on a screen, and then Kramer does his own version of my Madden with his highlighter, and he'll just literally say, okay, well, Ford and Toyota, they're in the same industry, so not so diversified. These guys are not exactly in the same thing, but pretty closely related. And love Exelon, one of his favorite utilities. I'm not sure about it myself, but he basically goes through it and says, okay, fairly well diversified, but some of these companies are in fairly similar industries, and then he'll kick out, go get some GE and some Oracle and sell one of the car companies, and then you'll be fine. Well, I think everybody here knows that that's kind of weak. That's not all that we need to think about when it comes to diversification, and I know that you can't do it with 5 anyhow. You need basically at least 8, and most people think at least 12. Some people think even more than that before you can even really talk about am I diversified. But that's not what I want to focus in on. I want to focus in on what we know as a community, that there's one other component besides making sure the companies are from different sectors and industries and spreading it out. But we know that, in fact, I put the tag urgent on it because of this graphic. This is one that we also covered on Thursday night. Taking a look at this graphic, if this doesn't convince you, nothing will. Most of us in this community know this. We're looking at a 20-year chart. The one down here at the bottom is the S&P 500. Those are all very large companies. The blue area, there's the lost decade. The blue area has gone nowhere for the last 10 years or so. And if you were invested completely in the S&P 500 for the last 10 years, and by the way, if you were in an S&P 500 index fund for the last 10 years, you may no longer be an investor. So index investing is not the complete answer to this. Over the very, very long term, maybe if you're a very young person, but for somebody who sees more opportunity on the planet than that, it's not always the answer. And certainly not a single one invested in just one real category of stock, that being very large companies. I think all of us here like the red line. The red line is the value line arithmetic average. The value line arithmetic average. And we refer to this as all of the above investing because there are some small, medium, and large companies. In fact, all of the S&P 500 are in it too. We know that it makes all the sense in the world to invest in all of the above. Get yourself some small, rapidly growing companies, some medium-sized workhorses, and yes, when these guys go on sale, and some of them will, I mean, they've been stuck in the mud for 10 years, some of these are going to get really attractive. They already have started, right? Coming up out of the Great Recession, some of those will remain quite attractive. But here's the bottom line. Investing in the S&P 500 over the last 20 years returned 7% a year. And all the above investing, as evidenced by the value line arithmetic average, gave you this. So that's a absolutely huge performance advantage, and it should be enough reason for most of us and most of you to convince fellow club partners that you got to have some small companies. Discover promising, exciting small companies, sometimes in your backyard even, to take advantage of and experience to stay on the red line instead of the blue area, because I think all of us prefer this to what we see down below. So this is a very important aspect of diversification. At Manifest Investing, we urge that you keep track of the overall sales growth rate of the portfolio. So in the case of the 5 stocks called into Kramer, Ford, Toyota, Exelon, Baxter, and Medtronic, I mean, they're all in the blue, big blue company pie chart, so they're obviously not diversified from that standpoint, and the overall portfolio growth rate of those 5 companies would be 3.8. So even if they were from 5 different industries and you still had this 3.8, I would do a handstand with Mr. Kramer and say, they ain't diversified. So what I would invite somebody in the audience to do is to grab 5 companies, 5 of your favorite tickers, and let's just kind of go through a quick demonstration for Mr. Kramer of how easy it would be to do this for a show. And in this case, let's go ahead and jump out. Anybody use your ticker tab, or if you want to be unmuted to offer 5 tickers, just let me know and we'll create a dashboard and show how easy it is to do this stuff. So I'll wait for somebody to give me 5 tickers. We're going to have multiple submissions from people, I suppose. Just what I need, another dashboard. I'll take the first 5 tickers I get. Here's an add a dashboard. We'll call it Am I Diversified? And then to show you how simple it would be, we're going to put $100 into each one of the ones that come across the transom. Here's IPGP coming in from Mike. Calavo Growth coming in from Julie. We've got Mygenics, and then we'll stop with the first 5 we get, and then we'll play with it. Submit them. And as usual, you guys come up with a pretty interesting list. High quality, some opportunity perhaps in these 2, the Calavo and Myriad, but we have a much better situation in terms of growth. Again, the recommendation from our community is to aim for at least 10, if not 12% for your overall portfolio growth. You can see they're evenly divided here, but now we've got a situation where you can instantly point out, well, it is diversified. You've got 4 different sectors. We'll take a look at industries here in a second. And, you guys just heard that story, so you may have been a little bit biased. You picked 4 out of the 5 were relatively small companies with more rapid growth rates. So again, you might be leaning a little bit too hard on the faster growing or smaller company side. Understandably, we know that that's where there's exciting long-term opportunity. Now, obviously, there's danger there also, but this portfolio is much more diversified. So slap those 5 logos up there. Better sector diversification. Which 2 are from the same sector? There's 2 technology stocks here. And the 2 technology stocks are going to be Synaptics and IP photonics. Let's go ahead and swap out IP photonics and replace that with something a little larger. Did you guys give me any large companies? Somebody give me a large company. We'll take Schlumberger. So $100 into Schlumberger. Come back to the portfolio. Now we really have gone for 5 different sectors. Schlumberger, great company. And actually slowed down the growth a little bit, but it's a more medium-sized company, so we've split this up a little bit better. So we don't have any of those giant monsters in the S&P 500 in there. But let's go ahead and just demonstrate how, let's throw 5 more tickers at it. Pretty easy to do, guys. And let's go ahead and throw another 5 at it and see how the diversification holds up. We're going to put $100 into GE. What else you guys want to throw into the mix? Fresh Market came up the other night. Let's throw that one in there. LKQ, I hate the company too much to put that one in. Sorry, Ruth. SodaStream, that showed up in the heavy hogs. I'm going to put Toyota Motor in there because that showed up at the top of the S&P nudge list for this weekend. And Linda Hunt, God bless you, offers up Stryker, good Michigan company. We still need your help out there. Okay, so now we've got 10 companies, still well diversified when it comes to sector. Jumped into a couple more staples, that's okay. But now you can see that with 10 companies, again, you're in more of a diversified situation. You have some large, some medium, some small, again, biased by some of our more recent comments. But now the overall growth rate of the portfolio is nicely balanced in around 11%. You can have a Toyota and you can have a General Electric so long as you also have some SodaStreams and some Fresh Markets in your portfolios. It's all about balance. And this is what I want to share with Jim. And I just think this could be an interesting new feature that would demonstrate an extremely important concept to investors. Kramer, love him or hate him, I happen to like him a lot. I mean, I watched the program for some interesting ideas. I think when he calms down and sticks to some of his analysis and industry studies and that kind of stuff, it's perfectly fine viewing, and he's really does. He's a closet investment club community member. If you listen to some of the stuff he talks about, especially when he's not throwing furniture, and even more importantly, if you take a look at their Action Alerts model portfolio, they behave like us in a lot of ways. Between him and Stephanie, a lot of the core holding stuff is evident in that portfolio. So that's why we have him as an honorary guest groundhog every year in our competition. Again, important stuff. Make sure that you keep an emphasis on the smaller companies, and I think it's an extremely important diversification concept that we all need to really pay attention to. All right. Well, I'm just going to close with a commercial, again, inviting all of you back to when it's not just me wearing out the microphone. Any one of these people could also be participating in the roundtable on March 1st. It's going to be, again, a Saturday morning special edition. I think we'll start at 11 a.m. March 1st. Again, register for that, and we'd love to have you. We'll be looking at some past selections, handing out some of the knight statues that you see on the upper right, and recognizing the all-time leaders, and during the course of the session, giving you some current favorites from any one of the groundhogs, including our guest damsels and guest knights.